Well, good morning, good afternoon, and good evening, everybody. My name's Zara Ritchie. I'm the Global Head of Transfer Pricing for BDO, and welcome to our Transfer Pricing Global webinar. Joining me on this panel this evening, we have Dirk Elbert, Partner leading Transfer Pricing in BDO Germany, Mark Schutte, BDO US, and Paul Daly, who's the lead partner from the Transfer Pricing practice in the UK.
Hello.
So there's no question that the economic and personal impact of COVID-19 is significant and more than this generation and our generation has ever seen before, and let's hope we never see anything like this ever again. The personal impact, the economic impact is extreme. And whilst the impact might vary between companies, between industries, between types of businesses, there's no question that it really has impacted everybody in so many ways. Perhaps some more than others, perhaps some have benefited because of the businesses that they're in or the industries that they're in, but probably the majority from our experience in talking to our clients is businesses have been impacted in the most negative way. And so that's really where most of our focus, but not all of our focus, will be on this webinar today. So I guess it's fair to say that transfer pricing is not necessarily going to be the top focus for all of you in terms of your priority list. There's a lot of priorities to manage in a challenging environment like this. But we wanted to share with you some practical insights, examples, and experiences that we're discussing with our clients because hopefully you can get some insights and opportunities to manage transfer pricing appropriately as it sees fit for your business. It will vary across businesses. The way that we're talking about the impacts of COVID-19 in our businesses and with our clients is across, I guess, 3 phases. So the first phase being survive. How do you survive this very challenging environment? What are some of the things that businesses need to be considering and focusing on just to get through and ride the wave of COVID-19? And what do you put in place to manage your position? Second phase is really striving to maintain those business operations, continuity. What do you need to be doing to ride the wave for sort of that interim medium-term position? And then third phase is really thriving. Hopefully when we all come out at the other end, we're as strong as we can be. We're all in it together. We come out of it. Of course, sadly, some businesses won't come out of it very well, but hopefully for most of us, we'll come out of it at the other end. So what do we then need to be thinking about and focusing on in preparation for how we get our businesses thriving again, our economies thriving again, what do we need to be doing? So as I said, this focus will be more on survival phase because that's really where most of we're all at, whether it's country or global at the moment. So we will be focusing more on what you need to be doing in the short term to survive. So as I said, practical, global, you have representatives on this webinar from Europe, Americas, and APAC. And so we're hoping to bring together some examples and insights from all of our different regions. I think it's fair to say that there's a lot of themes that are coming through from our discussions in preparing for this webinar and in our regular, BDO Global discussions that we have with our colleagues. We're hearing the same challenges, the same themes, the same questions that are coming from our clients. So I think you'll probably feel that there's a little bit of that coming through today's discussion as well. Perhaps just a little bit of housekeeping and the format for today before we get into the detail. You are muted, as I think you're all aware, so the only way that you can communicate with us with any questions that you have is using your chat box. So please do use the chat box on your screen. There are a very large number of registrants for this webinar, so we'll try and get through as many questions as we can. And if we don't, we'll try and respond to you after the webinar. The format is going to be panel discussion. And so we have a series of, I guess, topics that we want to talk through and share experiences and insights. And we'll leave 10 or 15 minutes at the end for participant questions. So please do log those questions as we go. We are going to start with some polling questions as well, just to set the scene. And at the end of the webinar, as soon as you close out of the webinar, you'll receive a request for some feedback. Please do take the time to fill that out if you can. We do appreciate your feedback. It's really important to us to receive your feedback so that we can ensure that our webinars and our events are tailored to what you would like to hear us talk about, what your needs are. So we would greatly appreciate if you can complete that feedback at the end of today's webinar. And finally, you will receive from us some post-event communications. So your local BDO member firm will communicate with you, provide some key takeaway messages, also a recording of this webinar for yourselves and or to share with a colleague, and also some links to some other BDO resources that are specific to COVID-19, transfer pricing, and more broadly as well. So please look out for those post-event communications as well. So without further ado, I would like to ask Sarah to bring up our first polling question, please, and let's use that just for some scene setting. So what is your current primary transfer pricing concern resulting from COVID-19? So please, if you could vote, include your comments, and we'll bring the results up. Sarah, do we have results we can bring up? Thank you. So it's probably not surprising, cash management and adjustment to transfer prices and ranges for 2020. So thank you for that. We'll cover off those. So maybe let's just turn to the first sort of kickoff question to the panel. It's fair to say that, you know, most companies, as I said before, are going to be experiencing losses. In your discussions with your clients, maybe I'll start with you, Mark, what's the number one priority or concern that your clients are sharing with you?
Yeah, so I think the poll questions really kind of are consistent with the conversations we're having with our clients. So the number one issue is in this survive period that you described is really cash. And I think the second issue of, you know, adjusting transfer pricing is a related issue. It's the second question that comes up. What can I do, knowing that my results are going to be, anticipating that results for this 2020 year are going to be poor? What can I do to change my transfer pricing policy, adjust that now, and then support that down the road? So I think that cash, and then how should I be addressing that now with my transfer pricing policy are really the two things we've been talking to clients quite a bit about.
Thanks, Mark. Dirk, from your perspective, anything different, or is it pretty similar?
Yeah, that's pretty similar. So you can see that it's a global crisis where the same issues come up in all the countries. So cash flow is the main concern of the client in this short-term period survival modus, and then other issues come up like adjusting transfer pricing system, whatever. But on short notice, securing cash flow is the main concern of my clients as well in the discussions.
Yep, thanks. Paul?
Yeah, very, very similar from a UK perspective. Cash, absolutely top of the list, and related to that, really the accessing of government-sponsored schemes in terms of lending, but also furloughing schemes. The Corona Job Retention Scheme is really important here, and I think that point about, well, what does it all mean for transfer pricing is common as well. And there was an OECD talk yesterday where it was clear that the OECD, the inclusive framework, being asked many questions about, well, how do we address this from a transfer pricing perspective? So it really is a global set of questions, I think, to a global issue.
Thank you. And just to round it out from a regional perspective, APAC regional perspective, in Australia, same. It's the same issues that are being discussed, and questions around how to make adjustments in the best way to move cash around the business and to release cash in the business, particularly to those jurisdictions that need it most. So we'll come back to that. Maybe, Paul, if I could start with you. Can we pick up on government stimulus measures or packages that you're seeing in the UK? Because there are obviously a lot of things that governments are doing all around the world. Some are doing a lot, some are not doing much at all, but some of the measures that are being considered and introduced to keep businesses going during the COVID-19 crisis. What are some of the examples you can share from a UK perspective?
Sure, I'll share a couple of examples and then I'll talk about what might be an important overlap with some of the transfer pricing considerations. So in the UK, I think similar to elsewhere, there's a combination of government financing being offered by banks, which is intended to be relatively short term on attractive interest rates, really to keep businesses afloat. Then one of the main incentives really, or government schemes, is the coronavirus job retention scheme, where employees can be placed on furlough and the government will pay up to 80% of the cost, subject to a cap of £2,500 a month. There's something broadly equivalent for self-employed as well. And there are a number of conditions attaching to the coronavirus job retention scheme, but a really important one is that to be eligible for the grant whilst on furlough, an employee cannot undertake work for or on behalf of the organisation that they're employed by, or any linked or associated organisation. This includes providing services or generating revenue. And the scheme is very much designed to provide the payment quickly to employers, but noting also that it will be potentially subject to audit. HMRC, our tax authority here in the UK, will be administering it, and they will also be carrying out audits in due course to ensure that it's being properly used. So the transfer pricing aspect for that is potentially an interesting one. So if the condition of the scheme is not to have those employees provide services or generate revenue, I think that needs businesses to be very careful down the line when calculation of service fees or representations of service provision by an entity employing those individuals is made, so that there is not a double counting, that the cost base of those individuals doesn't feature in the service provision fee, or somehow the underpinning of, say, IP, DEMPI doesn't relate to those individuals for those periods. So I think for me that's just an example of how it is that there's some really critical short-term measures, but also things that will need to be addressed over the medium and longer term as well, to ensure that there's a consistency and an appropriate accessing of those schemes.
Thanks, Paul. I think that those sort of furlough or salary subsidies, JobKeeper payments, there's all sorts of different names for them. I think that seems to be a fairly common theme across the globe. Dirk, from your perspective in Germany, anything different to the salary sort of arrangements or income arrangements?
So we have a different name, but pretty much the same content. Short-time work, we call it, where you can get your employees paid by the government for a certain time. So we have also government guarantees or loans to keep the cash flow alive. And the German tax authorities, coming back to tax, is very generous regarding tax prepayments. On the one hand, you can reduce your tax prepayments for 2020, and also assuming a loss carried back to 2019, you get some prepayments or even taxes repaid from 2019, which generates again cash flow for you. But the main focus is here the calculation of the loss you might have in 2020, or at least not a loss, but a reduced income, at least profit.
Thanks, Dirk. Mark, from a US perspective?
Yeah, I think the one, there's been a lot of stimulus efforts, a series of bills that have come out. But I think the one thing I would mention is this this ability to carry back net operating losses 5 years now. So I think this is an effort to allow companies to get a refund anticipating these losses. There's two things I think that we've been talking to our clients that they just need to be careful if they're going to go back and adjust their tax returns under this NOL carryback rule. One is you've got 3 years, 17, 18, and 19, that would be under our Tax Cut and Jobs Act, our U.S. tax reform. So lots of new rules, lots of new provisions. And so if you're going back and adjusting those years, you've got to model that out and make sure that you are understanding all the implications of those rules. Secondly, you're looking at going back and amending tax returns. So this may be for years where the tax year is closed. And so that will likely mean an audit by the IRS, and that will open that up to an IRS audit of your transfer pricing. So what we're talking to clients about is going back and doing a review. If you've got existing documentation, review that, make sure that it is going to be adequate to defend your position. If you don't have any documentation, we obviously can't go back and create contemporaneous documentation after the fact. But what we can do is put our best case forward, put some documentation together, knowing that the IRS is going to come in and audit this before they pay out any refund.
And thanks for that, Mark. We might come back to that, I think, a little later on, because the concept of how much analysis and evidence you need for anything that you might do in this environment, I think has got a whole sort of new and increased meaning to it. Just to round out the discussion, in Australia, we've got a lot of stimulus measures as well, and similar sort of JobKeeper payments and monies paid over by the government. What's quite interesting, I think I would say, is that there's also observations made by the tax authority in Australia that they'll be looking out for companies that are looking to exploit or leverage some of these stimulus measures. And so to Mark's point, ensuring that you've done your calculations correctly, that you do qualify for these concessions, that you're not playing with intercompany arrangements to try to qualify for some of these stimulus measures. They'll be looking for that. They've already sort of released some commentary on that in Australia specifically, where they perceive that some companies are going to defer payments or accelerate payments, or do all sorts of things to sort of fit themselves within the qualification criteria. So I think it's very important to ensure that that's managed. And of course, nobody wants to experience any greater risk or issue, particularly corporate reputational risk, as a result of some of these developments. The other comment that I'll just make on APAC, quite interesting. APAC is different because many countries across the APAC region, governments haven't introduced specific stimulus measures. So I think it does stand out as being quite unique and different from the rest of the world in that regard. So let's turn to 2 more polling questions, and that will be the last of our polling questions for the evening to set the scene. So Sarah, if you could bring up polling question number 2, please. So which transfer pricing policies are you reviewing for possible adjustments in 2020? Can we bring up the results, Sarah, if they're available? Okay. I like the last comment. Everything is on the table, and I think so it should be. Service fees and management fees as well. So obviously that sort of covers, pretty much 75% of responses. So thank you for that. Let's go to the 3rd polling question, Sarah. So how are you planning to treat your limited risk or routine distributors or contract manufacturers in 2020? Please respond. Let's bring up the results, please, Sarah. Okay, so 51% are looking for some guidance. So I think we're going to provide you some guidance on this webinar, so you're in the right place.
We hope so.
So it looks like 77% really don't know or haven't sort of taken any action yet. So I think the timing is good to be discussing these issues now. So thank you for that. So I might just add, I probably should have mentioned this at the beginning, so my apologies, but we don't have a slide presentation on this webinar. Our intention is to have a discussion, provide some of the practical observations, as I mentioned at the outset. So if you're looking for some slides and wondering why all you can see is 4 faces on your screen, that's all you'll see is our 4 faces on your screen. So sorry about that, but we thought the practical experiences would be worthy of sharing. So as I said in the introduction, many companies are experiencing losses, and so preserving cash, as you've said in your response to our polling question, preserving cash is your #1 priority. So we wanted to talk about some of the strategies in terms of how you might go about preserving cash or moving cash around or saving cash within the business. So I'm going to turn to you first, Mark, if that's okay. So from a headquarter perspective, can you maybe just share some examples or insights as to what you think companies should be considering?
Yeah, sure, Zara. So I think we've got a lot of U.S. multinational clients that have a cost-plus entity as a foreign affiliate, or a limited risk distributor, contract manufacturer that's targeting a certain margin and has earned a pretty stable margin while we've been in this kind of normal economic circumstances. And the #1 question they come back to us with is, how do I adjust my transfer pricing, given that the comparable companies that are being used to set these margins, that data is not going to be available till 2021. And so the IRS actually had, in anticipation of this question, a couple of weeks ago came out with some frequently asked questions around best case or just how do you do really strong documentation. There were about 6 questions around that. First question had an example: U.S. distributor that's making X% profit, and then goes through unexpected economic circumstances. And the response to that scenario basically talked about developing documentation, developing your story around what has happened, and not trying to go in and pull out certain comparables to get to a certain result. But really explain what's happened there. So that's something that we're talking with clients quite a bit about. How do you make these adjustments now with uncertainty as to what the rest of this year is going to look like? One of the things we've said is definitely you need to gather the facts, understand what your own forecasts are. How does that compare with the industry overall? Take a look at going to the lower quartile on your historic comps. But if you make a change at this point, definitely the need to monitor that during the year, and then at the end of the year, assess whether you need some true up based on the actual performance of your entity and the industry during that year. So I think that's really the advice we've been giving on this.
I think it's very important to distinguish between, is there a no risk model or low risk model? Very often the tax authority get confused and they apply a no risk model, but even a limited risk distributor, service provider, whatever it is, can have risks. So the OECD thinks we tax advisors provide low value adding services, and that's in the OECD transfer pricing guidelines. And if we now lose a client, have more costs, we cannot pass on those costs to another client. This will not going to work. That's even for a low risk service provider. You can have risks and you're faced with risks. And the same story needs to be told in this transfer pricing environment. That's at least my suggestion. It's difficult with the comparables. You can lower perhaps your rates, but you cannot reduce it that much as you need it at the moment. But if you explain the economic environment and you are in this low risk story, then perhaps the tax authority accept it.
Yeah, I think you raise a good point, Dirk and Mark, and I think the point about it's not no risk, it's low risk, and so it's also going to be really important to analyse and re-establish what the facts and circumstances are. So, looking at what's actually happening in country, what's happening overseas, what decisions are being made, how decisions are being made, and making sure that you have all of the evidence to substantiate whatever positions are taken. I think it's fair to say that, just like governments, companies are going to have to make policy and change policy on the fly as they respond to what's happening in the environment. And hindsight's a wonderful thing. And I'm sure everybody on the webinar could say that their government has done some great things and their government could have done some things better, looking back with hindsight. And I don't think it's any different for transfer pricing. I think you make the best decisions you can with the information that you've got to hand, and that might prove to be a good decision, or it might prove to be perhaps not a good decision, but you have to look back to see what you had at the time that you actually made that decision. Mark, maybe just a quick comment in relation to perhaps customs duties and the interlink between transfer pricing and customs duty, particularly in relation to distributors and the need for perhaps some adjustments to prices of goods.
Sure, yeah. In talking with our customs leader here, we've been discussing, our clients requested, they want to make these adjustments during the year. And so there certainly are customs implications if you're going to make an adjustment mid-year or do that true up. I think the advice is that he said is, look, if you're going to file for a customs refund, U.S. Customs is going to expect to see some type of agreement that really lays out the formula or the process of adjusting that to within an interquartile range or even below that range. That I think an agreement that walks through that is going to be really important.
Thank you, Mark.
I was going to say, I think that there's some really important points that we're bringing out there, and I completely agree about the difference between a no-risk business model and a more limited risk business model. I'd be very pleased to find no-risk business models. I think we all would in this environment. But I think it's a question that we're going to keep on coming back to, because certain decisions are going to need to be made now as to how policies are adjusted. And as Mark said, there might be some important ramifications for other taxes as well. But the data against which we are going to measure and test that is not going to emerge for some time. So we're in a very fluid situation, but also in a situation where we can't simply roll forward the expectation that we can derive from existing data. So in order to make those decisions, we might have to look back further. So are there other periods of time that we could use as reference points? What are the handrails, if you like, for some of the decisions that we need to make? And then one final point on that, the decision making itself. So some of the decisions being made now for the returns for certain functions, for types of entity, will of course affect their profitability and perhaps quite significantly. So it may be of interest in due course as to who was really making those decisions, how were they formulated, on what commercial basis was the assessment made, and were the boards and were the senior decision making parts of those functions actively involved in coming up with the commercial support for that in light of the difficulty of the normal data touch points.
I think that's right, isn't it? And I think
we discussed with a few clients whether we can apply the data from the financial crisis, because it also was a crisis and there were lower rates, fees, whatever. But at the end, this crisis were only focused on the financial industry, whereas now nearly the whole economy is in the focus, and that makes it difficult to apply those figures. I think you need to have some profit split considerations or other considerations rather than try to compare something which is not comparable at the end.
Yeah, I think what you're saying too, Dirk, is it's almost, I mean, the definition or our interpretation of arm's length is really very different in this environment, and policies are set, during or have been set during different times. Benchmarking has been done during different times. So none of that was set with the expectation that there would be significant losses or a significant reduction in margins across the whole business and the whole supply chain. So I think everything's on the table in terms of revisiting, and having a unilateral transfer pricing methodology or assessment one-sided is just not going to work. You really have to look at all sides of the equation. So yeah, maybe profit splits or loss split is going to be more appropriate in this environment, and then looking at the facts and circumstances and the forecasts and the data and the evidence in the market, whatever that might be and whenever that might be, are going to be critical in supporting positions adopted.
Yeah, this issue was included in the IRS guidance around these frequently asked questions, and basically they were advising if you've got a one-sided transfer pricing policy, to do what they were calling a self-assessment. So basically, step back, look at the impact of that policy on both sides. So not a formal profit split, but actually looking at the split of profit that results from that one-sided policy, and comparing that back to functions, risks, and characterizations of the entities in your documentation to say, does this split of profit make sense? And I think that's true in these times too. I think if you're going to make an adjustment, you need to step back and look at where does that leave the system profit overall. In talking with my colleagues throughout the Americas, they very often, their clients are subsidiaries of U.S. companies, and so while we can make these adjustments in the U.S., we need to be sensitive that we're going to have to defend them in these other jurisdictions as well. So it's a two-sided transaction, and that brings in all of the questions around uncertain tax positions that we're going to have to look at when we make these adjustments.
Absolutely. Yep.
You need to find some balance, because you cannot share the losses in bad times, but get all the profits in good times. And therefore, I think you can adjust transfer pricing for a limited period of time, even for routine entities, but you need to take care how long is this period, and what is the upside if we have an economic upturn again, that you share also some profits afterwards. I think the balance is important in this case.
I completely agree, and I think it's a reasoned application of the existing policies and characterization, rather than trying to reinvent on the fly a whole new policy and character of the entities. Yeah,
definitely
agree. In fact, I think the tax authorities are going to be looking very cautiously and carefully if there is a change or an interpretation of a change in the characterization of an entity, simply for the benefit of being able to perhaps allocate losses in a different way across the group. So no question that there's going to be focus on that. Dirk, can we just maybe very briefly turn to service arrangements, and some of these principles that we're discussing obviously apply in the relation to services as well. Do you want to maybe just make some brief comments? What else do we need to be thinking about if there are going to be adjustments to sort of cost plus service arrangements?
I think we already covered a little bit of this. So first, you have to review the agreement. Is there a no-risk agreement or a low-risk agreement? Can you do some adjustment to it? Then the benefit test is very important. Are the service really provided at the moment, or have you to reduce your cost base because only a limited services scope of services is provided at the moment? That's an important one. Unless you have some on-demand services where you can pay or charge something even if no service is provided. But this is important. Then how long do you do your reduction of the fee? It's only possible for a limited period of time. We already discussed a little bit the markup over cost. Very often we have cost plus systems in place. Can we reduce the profit markup, or can we even apply a loss markup for a limited period of time? And very often the defense file. You have to prepare a defense file where we, as already discussed, write down your story. What were the triggers for the measures you took in this crisis, and how you can justify it. It's we made experience from the financial crisis, even 3 or 4 years later, it's difficult to remember. So do the defense file now, then you have all the issues in your mind still that makes life very easy. In the discussion with my clients, where we have management fees under discussion and so on, we often so yeah, can you guarantee if we reduce it that it is not challenged by the tax authorities? Yeah, I'm not an insurance company. Even in good times, I cannot guarantee transfer pricing. I cannot do it in bad times. But you have also to keep in mind, if you do an adjustment now and you have to discuss it later, it saves you some time. So transfer pricing is never totally correct, but also never totally wrong, and you have room for discussion. So if you apply it now, you have some additional cash flow, and perhaps you can discuss it later with the tax authorities. With a proper defense file in place, you might be in a good position to defend it.
Yeah, and Dirk, on that, the related question we're getting is these crisis management costs you didn't have before. How do you deal with that, right? Should the parent bear that, or should that get passed on to the subsidiary? And it comes back to what you said, it's really a benefits question. The sun's coming up here. I'm going to close the window. I'll be right back.
Okay, thanks, Mark. Sun's gone down.
Whilst Mark's blocking out the sun, just to pick up on that defence file reference, I think, Dirk, I mean, I'm seeing that becoming an increasingly important concept anyway, the defence file, which is really the assembly of documentation and contemporaneous evidence to support positions at the time, reflecting that it might be 3 or 4 or 5 years before some of that is then subject to audit and scrutiny from tax authorities, and so it's preserving that information in an accessible way for posterity in some respects. And we'd seen that really coming to the fore anyway in the course of tax audits and inquiries, a greater desire to see the underlying contemporaneous evidence. So yeah, I think that defence file is a really key aspect of transfer pricing anyway, but certainly now when changes are being made.
And it's a bit of a challenge, isn't it, Paul? Because now is a time when companies don't have sort of the resources or the time to apply to building up that transfer pricing file, and perhaps don't have the budgets, if they want to outsource, some assistance in that regard as well. But it's a challenge, because now is the time to be doing that as best as possible. Maybe not immediately, as Dirk said, but certainly, while memories are good and you can create that audit trail of information available at the time and why decisions were made as they were, so that you have got the defence when the tax authority comes knocking. And I think for many multinationals, it will be a question of when rather than if, because governments need to fund, these stimulus measures somehow. And we all know that multinationals have been targeted in transfer pricing for many years, and there's no reason why that might change. There might be a little bit of a hiatus now, while governments are focusing on looking after their economies, of course, but they have to review this again at some stage in the not too distant future. So finding that balance between not over investing, but equally not under investing and being exposed when the tax authority does come to review. Perhaps, Paul, can I sort of keep the focus in your direction? We're talking about preserving cash here, funding arrangements. What sort of things should companies be thinking about in terms of moving cash around, extending perhaps payment terms, interest-free or interest period holidays, etc.? Can you maybe share some observations on some of the discussions you're having with clients?
Yeah, absolutely. We've been having lots of discussions around financing, and there are a couple of reasons for that, I think. So one is the business disruption being caused by COVID-19 is necessitating the provision of liquidity. So that in the context of a very fluid external situation, so base rates being significantly lowered, there's government-backed lending schemes, there's direct forms of financing being made available, and all that is having a really significant effect on groups, both of their external financing, but then also knock-on consequences for their internal financing. The other reason why it's a hot topic is the recent release of the OECD report on 11th of February on financial transactions, which means now for the first time Transfer pricing guidelines have a consensus-based view of how to approach the arm's length pricing of financial transactions. But when we come back and have a look at what's COVID-19 really doing to the environment at the moment. So we're seeing my clients, groups with external lines of credit being fully drawn to maximise cash reserves to meet immediate obligations. There's short-term government-backed funding being issued. Intragroup facilities are being used, often to their greatest extent, or new arrangements being put into place. Operational financing is being extended. By operational financing, I mean the type of financing where there might be the delay or the deferral of a payment for another intragroup service. So your service provider might not receive payment for some time. That is also a form of financing and may well be prevalent across many groups over the coming weeks and months. And I think it flushes out some interesting questions that will need to be considered. So the change in the external borrowing arrangements and projected cash flows will have an impact on the financial profile of the group as a whole, but also the credit ratings of the entities within that group. And a key part of the guidance that we all now have in the transfer pricing guidelines is around the assessment of the credit worthiness of the connected party borrower to really determine and test the conditions attached to the lending. So what's the margin for the lending, the quantum of the borrowing, what's the perspective of the lender, and something that's emerged that I think we're going to see tested time and time again over the coming period is this concept about aligning the credit rating of the borrower with that of the group in certain circumstances. In other circumstances, it may be that the credit rating of the borrower is on their own individual legal entity basis. And the reason why you might move the credit rating towards the group or the individual entity is really around some very subjective tests as to how important is that borrowing entity to the group. Because if it's really important for the group wouldn't let that entity go under. And so the entity looks a bit more like the group in terms of its creditworthiness. And that can have a big effect on the terms of the lending to it. And one thing I think we will see during this period of crisis and afterwards is evidence and demonstration by groups as to which of the entities are really important for them. So there will be the provision of emergency funding. There will be undoubtedly, and sadly in some cases, businesses that won't make it through, whereas others will be supported and sponsored by the group. And so that will create prima facie evidence as to which version of the credit scoring you could and should use. And that may or may not be consistent, of course, with the arrangements that have been put into place. I think the flip side is that it brings out the importance of guarantees, and where is it that explicit guarantees are being made to external lenders within groups, and is there any value to that? The guidance, the kind of way of thinking about it is that in order for an explicit guarantee to have value that you put a price to, there has to be an economic benefit to it. It has to be more than just the passive association, or more than the implicit support that I've just been talking about on the lending. I mean, one last point that we've been having discussions on as well is around cash pooling. And so cash pooling is a really important and effective way for groups to manage their liquidity and the cost of liquidity. And you will have different varieties of cash pools, notional cash pools where there is a swept balance into a master account. And there's benefit, of course, to doing that in terms of transaction fees and ease of access to funding as needed. But what happens when there aren't as many deposits anymore? So when cash is thinner on the ground, and in fact the cash pool becomes borrowing out of the cash pool rather than depositing into the cash pool, when does that arrangement start to change its nature into a longer term deposit or a longer term drawing, which will have an impact, or indeed a term loan. What does it mean for the cash pool leader? Are they really just an administrator, or are they the ones bearing the brunt of the risk and the meaning of their reward? So I think that's a flavour of the types of discussions that we've been having. And the same point we were talking about earlier on, this is all taking place in an environment where the ready reference benchmarks that we might have had a couple of months back are now in much shorter supply. And we're really kind of trying to do this in the face of great upheaval in external financial markets.
Thanks for
we
that.
had an interesting discussion with cash pooling with a client. If you receive a government loan or a guarantee from the government for a loan, and you are connected to a cash pool, and the cash comes from the government in the cash pool with the intention to save jobs on the ground in the country, and then the money is transferred via the cash pool to the rest of the world. Whether this is in the intention of the government, are there any restrictions in the agreements in all those conditions? So that's an interesting question you need to ask yourself. If you receive such money in one country, can you transfer it via a cash pool into another country?
Yeah, I think all of this really points to the need to review. It's 2020 is going to be a year where you really have to review your transfer pricing policies, right? I mean, even if you're not going to make changes, I think, you know, Dirk and Paul pointed out, there are just economic circumstances which just need to be considered. This is not a normal year, and I think that needs to be taken into consideration.
Yeah, completely agree. And Paul, thanks for sharing those very wide-ranging, colourful comments in relation to financing. I mean, we could spend a whole hour just talking about financing alone, and, you know, depending on the feedback that we get from this webinar, perhaps we will do that, you know, at a later date, because it's such a complex but important area, particularly right now. We are getting some questions coming through, so I am conscious of trying to perhaps sort of bring in some of the questions from the audience as well. And one of them is kind of a nice question, positive in a sense, because we have been focusing on companies that are not doing so well. And let's not forget that there are some companies out there, particularly in some industries or some types of product supply, that are doing particularly well. It might be medical equipment or hand sanitizer, or it could be online trading business, for example, where, you know, consumers are only sourcing goods and services online. So a question to the panel, and anyone's welcome to jump in on this, but what, if anything, different would you need to consider if your business has been generating strong profits through this crisis? Would you suggest that multinational group needs to do anything different, or is it just the flip side to what we're talking about on the loss side?
Yeah, I guess it's a flip side. You have your model in place. If you have a limited risk distributor and an entrepreneur, and for sure also independent parties, if the environment changes, they start renegotiating. If it's the bad side, they want to lower the fees or the profits of the limited risk distributor. But on the good side, if something is going very well, perhaps they want to have some extra profit. Not the residual profit, but some extra profit, perhaps higher in the range of possible profits. And I think it's pretty much the flip side of this. You need to analyze, are the economic environment you're in is changing so much that independent parties would renegotiate? That's a decisive question, and it goes in both directions.
Yeah, I do agree with that, and I'd say for me, it kind of flushes out the value drivers. So it puts a real onus and emphasis on, have we understood and articulated the value drivers in the right way? So when we see this uptick in profitability because of external factors, is that consistent with our understanding of the macro picture? And to make sure that's the case. Otherwise, yeah, you might have others wanting to take a share of that upside and say, well, it's actually only it's because of this value that's been created elsewhere that's now being flushed out because of the change in circumstances.
Well, it's also you need to identify also some upsides out of all of this, even if it's difficult. But assume you have transferred IP. We had a case where we transferred IP, we evaluated it. It was based on a forecast. for sure now the forecast is totally different because the economic situation is totally different. And we had a price adjustment clause in this transfer agreement. So we can now do a new evaluation, come to a lower value of the IP transferred due to the new forecast, and reduce this transfer price, which ends in a lower exit taxation for it. So, but it's difficult to identify the upsides in this crisis, but there are some, and it's also something you should keep in your mind, where you can change something.
Yeah, I think once the comparable data becomes available for 2020, you have to go back and look at historical comparables. Are they still valid? So you may have, just with a distribution set, you may have distributors in there, as you were saying, Zara, that are in industries that were extremely profitable. And so that those super profits may be sitting in those results. And then we're certainly going to have companies that are in parts of industry. So it's probably going back and comparing that to your tested party and not just blindly relying on the comps that we've used in the past.
Can I maybe continue the theme along the lines of sort of some optimism, but also supply chain restructures, and perhaps you know, what companies might consider doing with intellectual property when asset values are depressed as well in the current environment. But we are having a lot of discussions with clients around disruptions to supply, you know, manufacturing sites being shut down, reliance very heavily on sort of one or two jurisdictions or locations. And it's fair to say that a lot of companies are revisiting this, looking at how they diversify their risks, their supply chains, and this is a bit of a sort of a I suppose a reminder to businesses as to how they do need to manage their supply chains. And Mark, do you want to make some comment on, you know, what discussions you're having with your clients, and perhaps what some of the upsides are coming out of this awful crisis that is forcing companies to rethink supply chains, and some of the positive impact from a TP perspective as well?
Sure. Yeah, no, I think we're already starting to hear some discussions of onshoring, right, manufacturing and intellectual property in certain industries. I think there's the recognition that they are essential businesses, and so and not just the U.S. I think there's discussions in Europe with that as well. I think all the countries that have been impacted by this are seeing kind of the need to have that manufacturing controlled onshore, and so that's going to create a lot of questions around supply chain and movements in those supply chains. So yeah, I think we're already starting to have those discussions with our clients.
Yep, yep. Question that's come through in relation to, it's probably two parts to the question. One is how to justify deviations from existing transfer pricing models to auditors. And secondly, you know, can you go below the interquartile range? So I think that one part of the question is really picking up on perhaps, you know, IFRIC 23 and dealing with uncertain tax positions and transfer pricing positions as well in the current environment. Mark, from a range, interquartile range perspective, and the US can be quite strict in its interpretation of using an interquartile range, perhaps more so than some other jurisdictions. Can you see circumstances as a result of COVID-19 where you would expect to adjust below the bottom of the range, the interquartile?
We do, yeah. I mean, I think we've been talking to our clients about that. If their projections for their business and the industry are so significantly different from what they've seen with their historical comparables, we are seeing circumstances where companies are looking at going below the range or even to some type of loss sharing during this period. So, but as I said before, I think if you're going to make that adjustment during the year, you need to monitor that because there is so much uncertainty about how the year is going to finish out. And so monitor it during the year and then look at that at year end before you close the books to now that you've gone through a full year, that you're still comfortable that that change in transfer prices is defensible.
If I can just pick up on that, so from a US perspective and German perspective, European perspective, you know, most companies or many companies have a December year end. In my part of the world, there's a lot of companies that have a junior end. And so, by the time you get to the end of December, one would hope that we've been through the worst and, perhaps we're starting to come out the other end in some way, shape or form. We might not be through the crisis, of course, but we've perhaps got better visibility on the impact to the business and perhaps a better idea of what's to come. But for those companies that might have a junior end, we're probably still going to be right in the eye of the storm. So, what are some of the year-end considerations that those companies need to be thinking about? And we're certainly having those discussions with our clients. And indeed suggesting that they do engage, they do the analysis that they need to. And as we have already discussed, you have to make decisions on the fly. You have to use the best available information, whatever analysis is available to you at the time. And you might make some good decisions and some bad decisions in terms of how you make adjustments to transfer pricing, but you need to come to a view. And we would suggest that you do engage early with your auditors, your statutory auditors as well. If you do need to demonstrate whether or not you have an uncertain tax position in an uncertain economic environment, it's really a double whammy. So it still all comes back, I think, down to the same principles, having the right analysis, economic analysis and evidence available. It's just that the earlier your year end is, probably the tougher it is to make that call when you are in the eye of the storm.
Yeah, for any forecast, we need to. Sorry, go ahead, Mark.
I was just going to say the other side of that, Zara, I guess with the junior end is we have only a certain period of time toward the end of the year, right? That's been affected. So, but you're right. I mean, you're still in the same position of trying to determine what the comparables are going to do without that data.
Yes, and it depends on your business and the pipeline, because you might well be. I think we're in our side of the world, we're expecting to see significant economic impact in the second half of this year. The first half has really been about keeping people employed and in jobs or funded and the like. But the flow-on consequences, there's still a lot yet to be seen. Sorry, Dirk.
I think it's the same whether you want to convince a tax auditor or an auditor, you need to have some kind of defense file in place. That's where we come back to that, what we told or discussed before. So you need to have reasonable assumptions, and you have to document those assumptions. That those assumptions can be wrong right now in this situation. That's part of the economic risk you take as an entrepreneur. But I think the better your documentation around it is, the higher your chances are that you can convince any auditor who looks through your figures.
Yep. Can I just maybe ask Paul if you could make a quick comment, and this is not a quick conversation and one that warrants sort of deeper discussion, but in the interests of time, we have talked a little bit about legal agreements as well as transfer pricing policies. What are some of the things that companies need to be thinking about in the context of their existing legal agreements, the clauses that may or may not be available to them, perhaps reference to their own third-party arrangements and what they're doing as a business with their third parties in terms of renegotiating. Any thoughts on some of the immediate steps that companies need to be taking in relation to their legal agreements?
Well, I think there's probably an answer on legal agreements generally, but one conversation I've certainly been having with my clients are those agreements that cover access to IP. And so royalty arrangements in particular, and questions have been arising as to, well, can we adjust those arrangements that we have committed to agreements? And I think royalties, access to IP is really interesting. It's driven, as services are in some cases, by benefit. What's the benefit to the licensee of the IP? And at arm's length, we do see that licensors and licensees of IP will enter into arrangements that have certain regulation around the effective sharing of the value that royalty agreement is intended to do. So you might have royalty holidays that you see in agreements. There might be ramp ups over time or against thresholds. There might be specifications as to when it is that a holiday may be introduced later on in the agreement. That might be with regard to disruption to supply, or perhaps some doubt or potential infringement or some impairment of value of the IP itself. So that conversation has been coming up, and I think it's partly rooted in the economics of it, and the arm's length principle, but also in, well, what does your agreement say? Ultimately, that's the best articulation of the arrangement in place and the terms and conditions that attach to it, and then the documentation, the analysis is the complementing support for, well, on what basis could that be considered arm's length? So I think intergroup agreements are important. They will reflect and mimic to a great degree, in some cases, what happens between third parties.
Mm-hmm.
The difference between the two is it's a relatively rare, but certainly not unheard of occurrence for connected parties to sue each other. And so the kind of weight of the agreements in terms of its legal enforceability might feel a bit different, but actually the two should reflect, and we're seeing more and more intragroup agreements that are very close facsimiles of third-party agreements. So the same principle I would talk to there is generally as suggested on royalties, which is, well, what does your agreement say? What's the kind of the art of the possible within that agreement? But then taking that through to, what do we see third parties do in arm's length terms to introduce more sophistication into their agreements? How is it that they deal with the unexpected through some of those contractual mechanisms? And then you're into a question as to when and how is it that companies would vary the terms of the agreements already between them.
I think also, even if you have a legal agreement and you have legal rights in it, all the third parties in the first step, they renegotiate. If they find a new agreement, then, and you can convince the tax authorities in your group situation, this can be applied here as well, then everything is fine. The majority of third-party agreements don't end up in front of a court, but in renegotiations. And this should also be applicable in a third-party, in an arm's length situation. So it's, I think first is renegotiation, and then think about what are really the definitive rights in an agreement.
Yeah, the IRS's view on this in their recent guidance is you can't just eliminate the third-party agreements, right? You need to at least explain if you're not going to rely on them, why they're not comparable.
Yeah.
Yeah, and I think there is plenty of evidence in the market broadly, and I suspect in 99% of businesses' own commercial arrangements with third parties that will, provide some supporting evidence as to the renegotiations and the what reliance is being placed on the economic environment that they're facing as a result of COVID-19, because it is such an extreme impact. It's not just a slight downturn, over a season or a year. This is a massive change in the global economy, so it requires a different consideration. We haven't addressed some of the questions that have been coming through, so I've sort of been weaving them into the discussion for the last few minutes, but I'm conscious that we're at time. So what I'd like to ask from each panel member, in a very, very brief statement, any final words of wisdom or suggestion that you would like to share with our webinar participants today. Perhaps if I could start with you, Paul.
Yeah, so I think it's getting that balance between urgent and important action that needs to be taken now, but the managing and mitigating the longer term consequences of that, where some of the weighing of the judgments of those actions will be made.
Thank you. Dirk?
So I think we had it at the beginning: survive, strive, and thrive. And wherever you are, stay healthy.
Thank you. Mark?
Yeah, I would just reiterate, put a file together now. I think it's human nature that you forget, and the taxing authorities definitely will often kind of forget the period that we were in. So any information that you've got now that you can pull together and put in a file is going to help you down the road.
Thank you. Well, thanks very much to our panel members. Thanks very much to our audience for joining our webinar. There will be, as I said before, as soon as you close out of this, you'll receive a request to complete a survey. Please do complete that. Let us know what else you might be interested in, but please provide your feedback. You'll receive some communications from us in the next 24, 48 hours in terms of some key takeaways and the recording. And as Dirk said, I'd like to reiterate, everyone, please do stay healthy and well. Yourselves, your families, your businesses, we wish you all the very best, and we look forward to interacting with you in a more physical way, face to face, when we all come out of this at the other end. So thank you very much, everybody, and good day, good night. Bye-bye.
Goodbye. Bye-bye.
Thank you. Bye.